The FOMC decision is almost here, and I'm watching for a subtle shift. So ignore the guessing game of 75 or 100 basis points and focus on this little detail instead. Okay, let's start with what's priced in. The Fed funds futures market is at 87% for 75 basis points and just 13% for 100 bips. In reality, I think it's almost a negligible chance of 100 basis points. The Fed would have signaled it like they did at the last meeting, and those Fed funds implied probabilities are probably pushed up by hedges. In any case, that's not the trade. Here's what I think the trade is. What will move markets are signs of a slowdown in the pace of rate hikes and the subtle ways that the Fed might signal that. Now, market participants can get laser focused on those small differences in words and 75 or 100 basis points, but what ultimately matters is the terminal destination of rates. That's come down, but right now it's at about 3.38%. So call that 3.5 or 3.25%, and that's in December or February. And then it declines to 2.88% by November 2023. More than looking at signals about the September meeting, I'll be looking at signs or looking for signs about how the shape of the Fed funds curve will change. On the hawkish side, that could mean signals that rates will be held at high levels for longer, pushing up the November 2023 level back above 3% or even up to 4%. However, I think that's going to be tough for the Fed to do because the credibility of officials beyond a few months is stretched, and right now the market is in a phase about worrying about slower growth. So even if they try to signal higher rates for longer, it's questionable that the market will follow along. Now on the dovish side, the Fed could recognize signs that growth is stumbling, and I think even a slight hint there will be tradable. Slower growth is going to put downward pressure on inflation and may ultimately validate that transitory narrative coming out of the pandemic. Inflation is at 9.1% year over year, and the fail to foresee that or act quickly enough has left the Fed wounded politically. So they will surely have strong words on the commitment to fighting inflation in the statement and the press conference. But the risk is that they now tighten too much, too fast, and needlessly punish the economy with a harsh recession when prices are already falling. Great evidence of that came just this week from Walmart, who lowered corporate guidance and said spending was shifting to food from goods. The company had promised markdowns back in May and now says it will require even more markdowns to move inventory. Now that's not a unique situation. Companies in many categories of consumer goods have too much inventory and will be lowering prices. That's deflation. US food prices have also stabilized, and gasoline prices are down about 10% in the past 30 days alone. I could make a compelling case that inflation has peaked here and will drift lower through year end and into 2023. Now, what's harder to predict is where it will stabilize. Will it be 2%, 4%, even 6%? The Fed will be struggling with that question, but a big input will be demand. On Thursday, the Q2 GDP report is due and expected at plus 0.5%. Now, many are betting on a sub-zero reading and a technical recession there. That could be tradable as well. But Fed policymakers will be quick to dismiss that because of the effects of inventories and other one-offs. But they are attuned to the potential for a real recession starting now. What's important to note as well is that so far Fed policymakers have dismissed recession risks. Given some recent economic data, that's getting tougher to do. There are signs of a very rapid slowing in housing, which is one of the most sensitive areas to Fed rate hikes. Manufacturing is slowing quickly as well. That kind of pain will show up elsewhere in time. Comments from two leading Fed hawks, Waller and Bullard, indicate that their models show rates peaking at about 3.75%. But remember, that's in a scenario of ongoing positive growth. What happens when Fed officials start to see evidence of rapidly slowing growth? Even those Fed hawks don't see a recession coming, and when they do, they'll be taking down those inflation forecasts. And by extension, that'll mean fewer rate hikes. Now, this meeting is probably a tad early for that, but I think it's coming. And even if we see a subtle shift from Powell, or a hint of even open-mindedness to it. That may be all markets need to sell the US dollar and buy risk assets. I think that's the trade on this meeting, and that's what I'll be watching for.